Harshad, myself, we just thought since this is our first meeting for MIH Underwriting Pod, as well as going public with Valerie and Wealth by Choice networks, thought of, okay, set some expectation why we're doing it, why we're here, right? There are so many underwriting pods in the market, and so that's why I thought, okay, let's make sure that at least within this group we are clear why we're meeting, right? Why we're meeting every month, what's the objective and what we're trying to achieve. So that's the vision. I think is primarily to democratize the underwriting techniques, right, that focus on all the comprehensive analysis, risk assessment, and build a community of practice. So I think those are the two highlights that at least I would like to learn and drive, is democratize as much as possible and build a community of practice so that everyone can come and share their thought and learn and grow, right? And how do you do it? So the mission would be collaborative approach. So we do have a guest speaker, and Harshad will introduce. But the idea is it has to be a collaboration rather than a knowledge sharing, right? So I think we will make sure that everyone get enough opportunity to present, participate, ask questions, right? And hopefully we'll have guest speakers who are master in this area. We can talk about technologies, what are different types of data analysis and techniques to be used, and all the best practices to be followed. So we'll try to learn in that, right? So I think, so those are I think it's very high level I put it, so that make sure that at least I stay focused. I put my background also just to make sure that, okay, I am also learning the underwriting, every aspect of it. With that, I'll stop sharing and let Harsad kick it off.
Yeah. Thank you, Satya. I think before we get started, I just wanted to also take a moment to thank Valerie and Jonathan for sponsoring the Zoom calls for this. You guys have been very helpful, allowing us to also post it under the Wealth by Choice network, and yeah, just helping us organize this, and the poster as well. Thank you. That was a really good job. Thanks. So let's move on to the our guest speaker for today. So it's Scott Wilms. Scott lives in Arvada, Colorado, which is a suburb of Denver, with his wife and 2 kids. He works for a multifamily developer on the construction side as a project manager. And he has been investing in real estate since 2021, where he bought his first single-family home in Kansas City. He has done 2 BRRRR deals in Kansas City and still owns those homes. He has also invested in multifamily deals in Denver and South Carolina, both of them as LPs. And he started underwriting in July 2022 after joining the Jake and Gino community. He is actively pursuing deals in Denver and has developed good broker relationships and got some good deal flow going for him. He's always looking to partner with great people and great teams on any deals in any market. So take it away, Scott.
Wow, thank you. Satya, I thought I heard you say expert speakers on underwriting. So,
and you were the first one to kickstart.
Good that we shared my background. Yeah, I joined Jake and Gino last summer, so I've been underwriting since then. I'm still learning. Still love to learn from everybody else too. So as we go along, there's stuff that you guys want to look at or stop and talk about, let me know. So this is a deal kind of the west side of Denver. It's a 3-building deal that we looked at a couple months ago in Lakewood. I don't want to spend a whole lot of time on the OM, but if there's something you guys want to stop and see, let me know. But all 3 buildings kind of look like this. It's a I think it's a 1961 or 1970s vintage brick, fairly flat roofs. Generally speaking, it's 24 units. So it's 3 buildings that are 8 units each. It is 1961, which is pretty common to what we see kind of in the west side of Denver. And if you get in core Denver, you get into some older vintages too, but very, very typical vintage for kind of this location. So you can see the 3 buildings here. One thing to note when we get to contract services is this is a huge lot with, you know, lots of mowing and snow plowing. So it'll be something we need to factor in as we put those numbers in. So of the 24, 14 of the units have been fully renovated. And this group, I know this group that owns these properties, and they kind of go, I don't want to say overboard because they're really nice renovations, but they do a really good job. And you can kind of see like solid surface countertops, really nice cabinets. So here's just a map of Lakewood marketing package. Again, I don't spend a lot of time in the OM, and I don't use it for much because a lot of these numbers, we got to verify these numbers anyway. A lot of them are a bunch of BS when you get down to it, because they're just trying to sell the place and make it look as great as possible. But I'll check some of the things here, insurance and taxes. But again, we'll be, you know, verifying those numbers as we underwrite. So this is a pretty good picture of the kitchens. You can see, I mean, they're pretty nice renovations, and what they've done is like over here by this thermostat, I don't know if you can see my cursor. That's the entry, and this used to be just a deep closet, and they kind of cut into the closet and put the refrigerator back in there, which helps the layout a bunch. So one good thing that the OMs are good for are these sales comps. I'll steal these and put them into a database. You know, if you don't have good access to CoStar or other, you know, methods where you can pull this up, they've done the work for you. So I'll steal this and put it into a database and use it for comps down the road. So does anybody want to see anything else on the OM? Again, I kind of skipped through this pretty quickly.
Scott, quick question. So when you say put it in the database, but this should change, right? So you need to make sure that you keep on updating. It's good for maybe another few months, right? Those comps, then it might change. You need to make sure that we keep on updating that information.
That's true. That's why you know, some people will put in like rent comps. I don't spend as much time with those, but the sales comps, you know.
Okay, the sales comps.
Yeah, they'll be good for a little bit.
Yeah.
So just a quick rundown of the 24 units. You know, 14 of them, you know, are the full reno's been done. 6 of them, they've kind of started but not complete, and then 4 of them haven't been touched. So there's a little bit of opportunity here, but we'll kind of tell the story as we go along. Long story short, like these properties, they kind of got caught during their renovation at the same time that their loan is coming maturing. So let me go to the underwriting. I can kind of go through that too. So I always start with the rent roll, and you know, I plug it into the same workbook as synthesis just so it's there. And then also I kind of have these cells up here set up to where it'll take this information and plug it into the actuals tab over here just to speed things up a little bit. So this is after I have cleaned up the rent roll. The rent roll started out looking like this PDF. And so you just, you know, you do like your PDF to Excel conversion. And this one is kind of horizontally set up. So it was kind of a mess, but you kind of drag it into your synthesis and start cleaning it up from there. I probably spent more time cleaning up this rent roll so I could understand it than I did underwriting the whole deal. It just was very important to pull out the right information and go from there. So what I try to do is identify what they were calling out as full renos, part renos, and no renos, and then pull the actual rent roll rents and then put them up here. You can see they're all 575 square foot, and they're pushing $1,400 for rent on these apartments. So when I talk to people about investing in Denver, you know, I get a lot of like, why would I invest in Denver? It's so expensive. And it is. But the rents, you can demand more rent. And as we'll see, the expense ratio is a lot lower than where you see other places. Like we try to get it, you know, within, you know, 30 to 35% expense ratio, where a lot of these other markets, you know, you're in the 50 to 55. So there's a balancing act there. And it's a different appetite as far as the type of investment, but the same returns are available here as everywhere else. It's just a little bit different approach to them, and the appreciation is there without a doubt. So, so again, on this rent roll, when I plug it in, you know, I type all this stuff in, but this will feed that actuals tab. On the T12, on this one, I didn't get a full T12. I got a monthly summary and then a yearly summary at the end. So I had a full year of data, but it wasn't a T12 where you could look at it and kind of look for problems with month-to-month issues. If I had gotten more serious about it and wanted, you know, to put an offer on it, I probably would demand more information. But a lot of times, you know, you don't get a whole lot with some of these properties that we see. So as far as the T12 goes, again, you can kind of do the PDF to Excel, put it into this spreadsheet here. And I kind of got it set up, you know, month 1 through 12 across the top, and then the total column. And what I do is I have these 2 cells up here. One's called an income drop down. And all this is, it's a data validation that's pulling this list from the actuals here. And then I got an expense one that's pulling the values from here. So I'm sure you guys seen it, and I've seen it too. I used to do it, creating a pivot table to kind of get all the expenses grouped into the different categories and then add them up. But I take this and I'll copy and paste this income, you know, over here in the income categories, and you can kind of just drop down and put in what it is. And then what that's doing is it's assigning a category to these totals columns. And then what that will do is on the actuals, these all have formulas that say, you know, the sum if on the T12. So it's pulling the, after this takes the categories that are the same and adds them up, it's going to throw it into the actuals for us. This is just me like nerding out on a spreadsheet, but it does save me a ton of time, because as soon as I categorize those items, they're into my actuals. So that's kind of how we have been doing that. Go to the dashboard. I plug these in up here. I like to know these things up top, like gross square footage, county, the last year that it sold and what it sold for. And I always just pull that up. You know, if you go to the county, your county website, this will tell you a lot of information about these properties. You know, it'll tell you the history of the, you know, the property changing hands. It'll give you the current tax information. And I kind of use these numbers to do my own self-calculation with property taxes. And then again, like if I get serious and want to put in an offer, I'll call the tax assessor and just make sure I'm looking at it correctly. But I want to be able to do some quick math, so I don't have to call the assessor every time. But this is a great resource for a lot of information. Let's see. So I plugged that stuff in there. Typical dashboard items here. Their asking price is 4.8, which is, you know, 200 a door. And again, we'll get to it, but they got caught in a bad situation to where they can't prove a lot of income because they're in the middle of their renovation. So their income doesn't look good. And unless you're bringing cash or, you know, like a 1031, and you're trying to finance it, the banks, it's not going to work with a lot of the lenders, or most of them. So that's important to note, that this property and where we kind of left it to is we need them to get done with the renovations. We need to get them, 3 solid months of where they can be with income, and then we'll follow up on this property. But right now you'll kind of see these numbers are kind of crappy. Same inputs that we always talk about with synthesis. Right now in this market, you'll see a lot of 40 to 45% down, and even that isn't cutting it with properties like this where the income is not there. So I put a couple just highlight numbers right here to help me as I'm filling in these numbers. But you can see, like, purchase DSCR is 0.45, and once we get to the P&L, you'll see kind of, and also the actuals, you'll kind of see how that's happening. I highlight these two.
Scott, a quick question on that rehab capex. It's 155K. If they're doing the renovation, are you still keeping aside 155K, or I think, or do you expect that you'll have some more renovation on your side too?
Yeah. So what I did for those 6 that are kind of started,
Okay.
I put 10 a piece, and then 15 a piece for the ones that haven't started. And again, this here, I don't put a lot of detail in here unless I'm serious about it. So I just plugged in some plug numbers to give us a ballpark there. I highlight these 2 cells red to remind me how easy it is to make a bad deal look good, or a good deal look bad, by messing with the cap rates. It's real important to know, how you feel you're going to come out of the business plan. And really, it's really tough to judge. And I would love to hear anybody's opinion on how they kind of plug in cap rate at sale and cap rate at refi. But it's a number that you can just move just a little bit, and it'll affect quite a bit of the numbers too. So I just highlight them in red.
So how do we know? Like, what I have heard is, if current cap rate is something, then you just add 75 basis point.
I've heard, and
That
I've
exit.
seen, yeah, I've seen some templates do like 50 basis points off the current cap. And I think that's really common, and maybe 25 if you're refining kind of in the middle. I think those are pretty common. But again, like, sometimes you want so bad for a deal to work, like you start trying to pencil whip this thing, and cranking down the cap rate and getting excited, and you just got to watch yourself. So I put them in red just to say, pump the brakes a little bit. So so as you can see, this deal as is, even at 4.1 purchase price, has got a ways to go. But here in the actuals, I wanted to point this out too. So we talked about the rent roll is plugging in these current rents over here, and that rent roll was from February of this year. So they have more of the rents pushed up than was on that T12. That this cell C6 is the total from the T12 for last year. So they're pushing rents, but what that is doing is, GPR after, or right now, is 372, and what the bank's going to look at is that 290, and also this 105 vacancy. I kind of went through it real fast on the rent roll, but these are vacancies. So they've got 5 or 6 vacant units going hard after these renovations. So like I said, once they get this up, it'll look better, but then you got to analyze and consider, like, what's left for you. So if they renovate everything, get all the rents up, they'll have better numbers to sell it off of. But if you're a value-add investor, what's left for you? So
Scott, another question, that gross potential income, that 290K, is that the T12 or it's T3 annualized? Like, because anyway, you did not have the entire 12. And if you make it T3 annualized, would that number look good?
Well, this is coming off of, they had an annual total on this.
Okay.
I don't know, some people call it a profit loss, some people call it like a cash flow, but I had a full year of data here. And that's where that 290 comes from.
Okay. Okay. But if you do T3, because you said that they are already increased the rent, and if you do T3 multiplied by 4 annualized, because that gives you the latest rent. I think some banks, I think Freddie Mac or agency, they look for T3. It definitely they go check you're getting a consistent rent. But I think T3 might work in this case if it is coming around that 372. I don't know how that number would look like, that 290.
Yeah, that's a good point. I know we can plug it in and see what it does. Yeah, I think T3 is, we had Eric Stewart talk to us over the weekend at the boot camp, and he said the same thing. He's like, get a T3 that looks good, and it'll help push the deals through. So yeah, after that on the P&L, it's pretty straightforward from what we've been seeing. When Satya and Harshit and I were looking at this before, Harshit pointed out, and this was just how I was taught. I've seen a lot from Anna and Fernando, and my coach kind of taught me this way, but they put the rents up right away here. So it's showing like a 12% increase, but then what they are doing is cranking up this loss to lease to account for the renovations and the other reasons for loss to lease, and then you slowly burn that off to get to your pro forma number. So it's just a different way of looking at it. You can do it the other way where you're cranking the rents up. This is just the way I was taught, so I've done it ever since. But that's why it looks like, you get that question a lot. Oh, Scott, sure, you're going to come in and raise rents 12% first year. Yeah, no problem. It's really, we're still showing 20% vacancy down here to be a little bit more realistic with things. As far as filling in the expenses and whatnot, I've kind of thrown these columns in here to help me kind of walk through plugging some numbers in. This is just like other income worksheet to where I can put in rubs. If you have properties with like studios and then 3 bedrooms, you probably, want to think about doing different rubs for different sizes of apartments. And then parking, pet, laundry, all the stuff here. I think I heard, there's a video that Hadar did that said, if you're trying to fine tune your laundry income to make a deal work, you probably need to stop. Like this should be like, he called it cherry on top. You don't want to be, pencil whipping your pet rent to make a deal work. But again, if you start looking at 200 or 300 unit properties, that $15 a month will make a difference. So this is what I was mentioning before. These are the 3 counties that I typically look in the most. And I've just, again, nerded out on this and put in what I know the assessment rates and the mill levies. And this will give me, the purchase price, what we buy it for, what the taxes will be at that purchase price. And again, you got to know like your timing. Like these 3 counties, they assess every other year on odd years, and they do it at the beginning of the year. So like this year's 2023, if you bought a property now, you'd still be kind of grandfathered into the last assessment until 2025, at which case they take your purchase price from today and then assess or reassess the property and raise the taxes. So this gives me a very, very conservative look at taxes, but again, I'd like to start there and kind of back down and make it more realistic. I just put some notes in here. These are 2 different insurance sources that I go to check on insurance from time to time. It probably should be at least quarterly. Insurance is really going up from what I've been seeing, so those can affect your numbers quite a bit. this is a very general thing where they're saying, hey, if it's 8 to 12 units, figure 700 a unit. And so I just kind of use these figures to plug in this insurance number here. And then here's contract services. Again, you can kind of talk to your property managers, get some information here of what it's going to cost for these, snow, landscape pest, common area cleans, and things like that. So it's just worksheets to help me fill in these year one expenses. I think that's pretty much it on the P&L.
Scott, I
Yeah.
have a question. I see that your expense ratio is at 39%. Is that pretty common for the Denver area?
That's kind of high. We want to get that more like 35 or less. So there might be something that that is making that a little bit higher that I could go back and tweak and get some better information to get it lower. But 30 to 35% in this market's pretty common. And the rest of the tabs are pretty straightforward with the, your refi and your exits, closing costs. Chris talks about in his videos, just kind of going with the 424. I look at them and it's usually pretty close. And if it's something different, I'll change it. But 4 on the acquisition, 2 on the refi, and 4 on the exit. We kind of looked at the CapEx and reserves. This came up in our pre-call. I did talk to some lenders this week about, tax and insurance holdback. And he said there's some situations where, they'll want a little bit. I'll just encourage you to be in constant communication with lenders and see kind of what the requirements are these days. But these are just some kind of reserves that, again, I've just kind of plugged in some formulas to make it easier and quick. Operating reserves is just taking OpEx, asset management fee, and CapEx, and I can kind of plug in how many months. But again, a lot of this will be lender driven. So I think a big part of it is just maintaining communication with everyone, insurance, property managers, your tax assessor, and just making sure you have the most up-to-date information because it changes all the time. So I didn't really do anything with returns because it's not something to look at closely yet. But yeah, that's kind of how I go through things and work my way through the spreadsheet.
Hey, Scott, I had a quick question. And I don't know, this could be what it is for the Denver area. So definitely educate me, correct me. It seems like the average cash on cash return is a little low. Is that normal for Denver, the Denver area or the surrounding counties? And would this strategy be more of like an equity play at the end versus like a cash flow play right now?
Yeah, you'll see, if this was something that we'd want to look at and pursue, we're still looking for the 7 or 8% cash on cash or 9 or whatever. But what you'll see a lot here is, year 1, maybe 2 or 3, and then you're kind of slowly building. And then with the appreciation play, you catch up at the end with the sale or the refi. So we still look for the same returns that everybody else looks for, but it's not going to be 10% out of the gate, so something to keep in mind there too. I just, I appreciate the opportunity to show you because like I get on a lot of these calls and, it's just the difference in the market and, the per door pricing. And, but as I mentioned, the returns are available. It's just a different way of different business plans and different ways of going about it. So.
Yeah, that makes sense. Thank you.
Just a quick question, Scott. Like I know that you have mentioned the vacancy rate on this property, right? So, what do you know? What are the reasons that why it has been vacant for so long, and then they weren't able to, lease the tenant, or is it because the rent that it has, or the people are renovating? What is it that they don't have a lot of like I mean, why they have a lot of vacant
They-
properties.
They
I'm
got
basically
caught. Yeah, they got caught in the renovations. So I toured this property a couple months ago, and they had 4 units completely vacant, working on renovations. So their loan is due this summer, and so they're in a bind, and so they're trying to accelerate as quickly as possible the renovations to where if they had more time, maybe they would do 1 or 2 at a time and keep the vacancy up. But they kind of got caught with their pants down, to be honest, and they're just trying to get it stabilized as soon as possible. Satya, Harshit, is there anything I missed?
Yeah.
Hey, Scott, I have a question. Your cash on cash says 3.84%, but your pref is 8%, and it says pref achieved. That doesn't sound right? How is your pref achieved if your cash on cash is 3.8%?
I'm not sure. It might be like a conversion, because I use Google Sheets. But to be honest with you, I started using synthesis again about 3 or 4 weeks ago. And so some of these things I don't have the answers for, but that could be why these formulas aren't working. And I can check into it.
Yeah, looks like that's not a formula also. Like look, if you see the top, it's just straight type,
Right.
right? It's not a formula.
It's like
Okay,
the
okay.
conditional
All right.
formatting.
Yeah.
But I
Yeah,
have noticed
yeah.
that like when you go to if you use Google Sheets, there are a few things that some of the conditional formatting and the signals and some of those things are off a little bit. So I tend to just focus up, I try to look at the numbers and but that's a good point. I'll try to figure out what's going on with that.
Thank you.
Hey guys, I have a question. I don't use synthesis yet. After we get done with this current deal, then I'll pivot to this product. But is synthesis intended to be used with Excel or Sheets or both? What's the intention? The platform?
Carlos, yeah, I've been using synthesis for like a couple of months now. I would say it works best with Excel. As Scott mentioned, some of the formulas do tend to break with Google Sheets. I've observed the same thing as well.
Okay,
The only thing that I've noticed is some of the,
thank you.
Yeah, the only thing that I've noticed is some of the triggers and some of the conditional formatting. Because like I said, I still use some other templates, and I always, if I'm getting excited about a deal, I'll run it on a couple different templates, and it's, the synthesis is right on. I think it's just some of the, the warnings that come up and things like that. So
I think it's because it's still Excel, right? But the moment you open it in Google Sheets, like you've stored it in Google Drive and somehow double clicked, it all messed up. Even if you download back to Excel and open it, and it all messed up, right? So I think when we store it in Google Drive, have to protect it in such a way, right? So that when you open it, it will ask you to open it in Excel rather than open it in Google Sheet only in online mode. So I had a question like, Scott, did you make an offer yet? Like any LOI on this one?
no, I had a conversation with the broker, and I just told him that the financing was going to be the issue with the income where it's at, and he knows that. So as I mentioned, this is in the queue to follow up with him and see what this looks like in a couple months.
Yeah, I think that we need to have like clear pictures of the rent roll. What you have said that and they haven't provided to you, in order to have like exactly what is what it gives. Once we have that, probably otherwise it won't make. I mean, I mean, I'm just my personal view is that if we don't have exact, information, then it's hard to like, even like understand, and also the, see where the like, the I mean, what I'm trying to say is that, even we could not like, put an offer if we don't have clear picture. You know what I'm saying? So that would, I would say, first priority if planning on to put an offer, so that you have like the exact, informations, and then you can, talk with the you know the broker or whoever he is. So yeah, and also the rent. I don't know. I mean, I'm not familiar with that area, but rent with this less than 600, square foot is right. That's what you said. I think it's a pretty high. I don't know what is the comes around on that areas of rent of the similar um, similar units.
I mean, it's pretty common, and they're getting that 14.
Mhm.
You know, some of these units they're at. I mean, this one's at 1495. You can get 1450, but right now, what scares me is that'd be it. I wouldn't factor any more rent increases for a while. You know what I
Right,
mean?
right. That makes a lot of sense.
So, I was comfortable with the 1450 because they're getting them with the renovated units.
Mhm.
But like I mentioned, like what's left, 'cause
Right, right.
I have zero confidence thinking we can bump these,
Yeah, no meat on
I-
the bone, huh?
yeah. So, yeah, I picked this deal because it's kind of representative of a lot of things that I see, but it's
Right.
definitely not nothing that I considered. It went in the queue and out the queue pretty quick, but I always keep data on everything, and I keep reminders to check in on properties because I haven't seen a lot of new deals in the past couple of months, one or two, but I'm seeing deals that I underwrote last October and last November, and they're coming back around, and these buildings are still sitting here because the prices haven't adjusted. So I always just keep these in the file and keep in contact with the brokers and say, hey, whatever happened with West 8th, what's going on there. So um, that's how a lot of deals are happening now, is just they're coming back around, and the people that are pushing and just keep bugging, the deals will happen. So
And just a question, maybe everyone can chime in. So that's 7% or 8% cash on cash. Is it still reality in the current market? If I'm asking, like I was just doing underwriting one deal in Greensboro, North Carolina market. So it was in Zillow. Then I think I reached out to broker and gave me, I think, rent roll and T12, and I underwrote it. A number doesn't make any sense, right? It was a 36 unit charging 3.7 or something. So if I bring it down to 2.8, then only I think it was coming around 15% IRR. Then next day I was able to send, okay, this is the offer, not the formal LOI, but in midnight I checked Zillow and it's under contract. So somebody definitely, I don't know how much they quoted, but definitely it went under contract within 7 days. And I followed the template. I'm hoping that I did not miscalculate anything. So the numbers did not look good, but somebody definitely putting offer. I don't know if they will buy it or not, uh, but uh, but it's in Carolina. I think people, it looks like they might be putting an offer. I don't know if they really buy it or they buy it all cash or whatever it is. Just wanted to understand the realistic expectation in this market. Is it 7% still realistic that we continue to underwrite with that expectation, or we lower the expectation? Any comment, anyone?
anybody?
I don't know. That's really variable, right? I mean, it depends on how much meat's on the bone, right? What is the value add?
Yeah, I mean, I think it's like Carlos said, and it's basically dependent upon the individual investor. But if I were to be like consider those things, I would not go like below 10%. Cash and cash. Because like maybe some person people might not think that for me less than 12, I don't even need to think about, or less than 10, I don't even think about it.
Day
But if
one,
like no, the return, so but if you have like really you can appreciate the first appreciation of first add value. If you can see that, maybe some people may be okay with less than 10% for now. So that is
Summer,
like, yes.
are you meaning the final cash on cash for the projected business plan or at purchase?
No,
What
what
do
I'm
you-
saying is that once at the process purchase, when you see analyze the deal, we normally see like on a cash and cash at least 10%. If
Wow.
I mean if not, then probably we would like think twice. That's just simply because sometimes even though you see on a good return, but after once you get the property under you, and there may be a lot of things that you need to stabilize. So I mean, again, it's like depending on the person to person. It's not necessarily if I go if I don't go take the deal that is less than 10% return, and maybe there are other people who can take it. It's basically depending on situations where it
But
also
Summer,
location.
when you talk, when you talk about 10% cash on cash, so what would be your equity multiple that you're looking at? Do you still get good cash flows and good appreciation in those deals?
Well, I mean, every investor is I believe look for all those things. Try to get a lot of meats on the bone, and especially if you compete with the like everything already been exposed to the market like Zillow or whatever other website. But you can get it if you go like off market deals. You can get those deals if you have good connections with the your broker, and that's how we have been getting those kind of deals. But again, it is not the it is not the deal that we have getting is not for the multi-family, like 20 or 30 or 50 units. We are just talking about quad, make sixplex, plex, triplex like that. So maybe in a bigger sense, if you are going for the 150 200 units, that may be totally different, because you don't get that much of you don't get you don't expect that much of return, and then have a multiple, because in a multiple units you have a smaller return will make some bigger gain. You know what I'm saying? Because the numbers are there more.
Scott, I had one question regarding the interest-only months that you had. So you had 12 for your interest-only months. So when you're conservatively underwriting, do people normally not assume any IO months and consider IO months as a cherry on top, or is it normal to use 12 months for interest only?
That's the way that I was taught, is go through it without, but IO is pretty common, that you can get it from what I understand. So I always go through without any of it, and then I start plugging it in, and then quick call to the lender just to verify, and again, he's going to tell you like it's deal specific, and he wants to see everything and, not lead you down the road. But I always start as conservative as you possibly can, and then start plugging those things in. But I don't know, Carlos, what did you see? You getting IO? You getting like 4 years of IO on your deal, or what?
Three years.
Nice.
3 years of IO.
Yeah.
Yeah, and step down. So this is a pretty conservative deal. I've said that before, and it's we asked Praveen, who's another primary JV partner in this deal, what he recommended, and he said step down. So I asked the lender, and it adds a few basis points. Satya, I forgot how many 10 basis
Yeah,
points?
4.5 to 6.5, 20.
Yeah. So it adds a little bit of onto the rates, but it's worth it. So on a 10-year, it would be 5544332211. And then you can start looking at your refi based on that and how much it would cost. So, you can play with the exit strategy, and you can apply that now that you're always fine tuning the spreadsheet, right? Especially when you're getting the rate sheet. And once you know what your exit strategy, what type of penalty you're going to be paying, if at all, then now you can apply that to your, if you have a tab for exit strategy, you can apply that percentage of that penalty and get a more accurate picture. Do you guys follow me?
Yeah.
Because
I think personally, I think it's a fine line, right, between putting IO and not, because from my perspective, if I think of it this way, that I'm competing with other investors as well, right? Let's say you have good relationships with your community bank, and you know that you can get that trade with some certain IO, and that's what you're underwriting. You're gonna make potentially a higher offer, right, or better offer than me, and I'm gonna lose out, right? So I know it's not easy, but that makes it more challenging. So you gotta, I guess you also cannot underwrite too conservatively.
Yeah, I think our broker said underwrite without any IO.
zero IO.
Right, 0 IO, 6%.
And then when you put it on there, you go, wow, that's
Yeah.
the cherry and the sprinkles.
Then you can, but
and
you
the
can
whipped
also
cream.
put both, right? You can still put both and see
Yeah.
the number, compare the number, and you can pick and choose. But he also said if it is an agency loan, small business loan, it's 3-year IO.
Small
That's
balance.
fixed. Small balance loan, and if it's I think then the bigger ones, it's 5-year IO. That looks like that's common with the agency loan. But with community banks, you need to have a good relationship to leverage those. Yeah, I think we have 6 more minutes. I don't know if good to have a quick feedback. Like, how was this call? I think if anything that we can do for the next one.
Questions, Satya. So you guys are talking about IO, right? So like 3 years or 5 years. So after that, what would be the interest rate? Is it like carry on the same thing that you pay
Interest rate will be same, but you will be paying down your principal too.
principal too? Okay,
Yeah.
we'll do the same rate.
Yeah.
Okay.
Yeah, good call, guys. Nice. So what's the verdict? You're just gonna follow that property, Scott, sorry. Scott, you're gonna follow that property and see where they go with the renovations, right? And then see where the rents are at.
My guess is there won't be enough left for the next guy. So all the deals that I look at, I use like I think it's called Streak. It's a like free plugin for Google
Mhm.
Mail. It's like a little CRM. So I put the deal in at the top and then kind of move it through the stages. But I have a bucket where like, hey, follow up and whatever. You can set reminders like June 1st, follow up with West 8th or whatever. And I think that's the key right now is like the follow up and waiting for these deals to come to you because they're coming back around. So yeah, it's in the bucket to follow up on, but
I would probably put a post-it on the wall. Just leave it up there until the day I call and then just tear it off.
yeah,
Hey, there's that post-it. I can't tear it off until that date.
yeah.
Scott, so I'll be definitely in Denver around October, like, so we can go and visit that property.
Do it. Let's do it.
Nice.